Hi, everyone. My name is David Kosmeter. I am the creator of TimingResearch.com, and this is our show for December 8th, 2014. We are going to be talking about the 63rd weekly report. And if you have not had a chance to look at this yet, just go to TimingResearch.com/reports, and you can download it there. Dave Landry is guest hosting for me again today, so I'm going to turn it over to him now.
Thank you, David, and thanks to you and Timing Research for having me once again. Today we have James Ramelli, and James, I hope I got your last name correct on that. That's what I meant to ask you before the show. And Glenn Thompson should be joining us soon. He's from Pacific Trading Academy. Benjamin Lee couldn't make it. He had some issues last minute, but he may pop in later in the show. And he's with ThinkTradeThink.com. James Ramelli is from Keen on the Markets, and Keen on the Market, I'm sorry, and he's in chilly Chicago over there. James, welcome to the show. Tell us a little bit about Keen on the Market. Tell us a little bit about yourself, and then at the end of the show, we'll have some time, and then we could anything else you might want to add in, you could add in at that point too.
Sure thing. So my name is James Ramelli. I'm a trader and moderator here at KeenOnTheMarket.com of our live trading room. Every single day that the market is open, from the time the market opens till the closing bell, we break down chart setups and dissect unusual options activity and equity options order flow for our subscribers. We have about 500 people that join us in the live trading room on any given day, and we do this for our subscribers every single day. And our main focus is equity options. So I would consider myself a trader of pretty much anything that trades, but my main focus would be equity options.
Oh, very interesting. Okay, James, while we're waiting on Glenn to come in, let's go ahead and get started on the question. So based on any technical or fundamental indicators you use, would you guess that the S&P index will move higher or lower by Friday's close? So the close of this week, do you think the S&P would be higher or lower?
Right. I think that we're probably going to see the S&P head higher into the end of the week here. We had a pretty choppy trading day so far today. S&P futures opened up lower, ripped higher, tried to trade into positive territory, and are now lower again today. I always take a look on Monday when the market opens, what the options market makers are pricing into the S&P in terms of what they're expecting as far as movement. And this week they're looking for about 16 or 17 points in the S&P futures to the upside or to the downside. That's actually a little bit less than what we would normally see. On average, we probably see around 18 to 19 points get priced into the options market. But if we take a look at what we have this week in terms of macro data releases, we really don't have a lot. Today, tomorrow, and Wednesday is pretty bare until we get into jobless claims and some retail numbers on Thursday and Friday. We do have some earnings this week. None of those stocks are really bellwether names, so I don't know if they're going to move the market that much. So what we've tended to see happen over the past couple of weeks here is when we have these big gaps in macro data releases, the market can just kind of tend to grind higher. There's still buyers in the market. These dips are getting bought. The lower that crude oil goes, the more optimistic traders get about the consumer and what that's going to mean for these corporate profits going into the end of the year and into the next quarter.
Okay. When you're doing your analysis, are you using implied volatility on the options to predict the range for the S&P for the week?
Right, so I can use implied volatility, but a much simpler way to do this without having to do too much work is just to look at the price of the at-the-money straddle. And when I look at that straddle price, that's going to tell me what the market makers are selling to the public. So when they're pricing that around 17 points, saying this is what we think the range is going to be this week, 17 points to the upside or to the downside, we're going to close somewhere inside of that range. So once I have that range, I can then use that to center strategies in the options market. So if I'm bullish, I can say, okay, well, I need to get long with a profit target about 17 points to the upside if I plan on holding through to Friday. And the same thing holds true for individual equities.
Cool. No, that's fascinating. I like the way you're doing that. Does put call equity? Let's see. Does what do you call where the puts must be a certain price within the calls? Is that put call equity?
Put call parity.
Parity. I'm sorry. Does that so that sort of plays into that too, then, right?
Right. So I mean that's something that's going to hold true all the time because if it doesn't, then it's an arbitrage situation that
Right, right.
might appear, a few times during a day or during a week. But I mean, the amount of time that situation is present is going to be snapped away by an algo scanning the market within a matter of seconds. Basically, what I'm looking at is the amount of premium that they price into the at the money calls and the at the money puts tells me what market makers are expecting.
Oh, okay.
So, when I'm looking at something that's at an option that's at the money, there is no intrinsic value, right? Because if stock XYZ is at 100, the 100 calls and the 100 puts on Friday will still be worthless if the stock is at 100.
Right.
So all of that premium, all the value in those contracts constitutes extrinsic value. And when I have a contract that's all extrinsic value right at the money like that, I can use that to kind of project where the market makers are expecting the stock to go. And I really believe that the equity options market makers, the futures options market makers, are the ones that know the product the best.
Yeah.
So when I'm looking for targets, I want to use the targets that those guys are calculating.
Yeah, a lot more sophisticated players. You're saying so we're going to be up at the end of the week, and based on that, can you rate your confidence to your answer on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident?
I would say probably around a 7. The one thing that is kind of tricky here is that, we see crude oil continue to sell off. I mean, we're down over $2.30 today. So that's really good for one sector of the market. Everyone gets really optimistic and really bullish around retail stocks and around anything that's tied to the strength of the consumer, because we're talking about literal billions of dollars being put back into the pockets of U.S. consumers right around the holidays, and that gets people really excited about retail stocks. That gets people really excited about consumer discretionary names. But energy is a big part of the S&P too. So
that was my next. I was wondering if that's where you were going with that. Yeah. So it's kind of a double-edged sword there. That makes sense.
Right. So I mean, it's a time to be really selective, because I think that cheap oil is good for the market and good for the U.S. economy. But if I can kind of get long the broader market while legging out some of the oil names by buying puts in individual oil stocks, getting short individual oil stocks, then I've got a portfolio that's a little more balanced and should outperform the market if the trends continue.
Okay, cool. Okay, I'm going to go ahead and throw my 2 cents in. One thing I don't like about the S&P 500, and I wrote about this recently. Oh, by the way, I'm Dave Landry, and I'm with TimingResearch.com. I'm a short-term trader, but because I think you can only predict the short-term when it comes to the markets, but I'm willing to hold on positions as long as the market moves in my favor. If anybody's interested, I have a 21-page report, free report I'll give out to you on the basics of my methodology. I'm slotted as a swing trader, but I will stay with the position, again, as long as it moves in my favor via trailing stops. As a trend follower, I'm not going to argue with the market making new highs in here. One thing I don't like, as I wrote about in a recent column, is the fact that the momentum has decelerated in here, but the market keeps grinding higher. So I don't want to think too much and outthink it, and my nickname in the industry is a trend-following moron, because if it's going up, I say the market's going up. If it's going down, it's going down. If it's going up, I want to be long and not short much, and vice versa. If it's going down, I want to be short and not long much. So with that said, I think we're headed higher. A little bit of corrective action today. I'm glad to see a little bit of volatility come into this market. I like to see it move around a little bit, but I think we'll be higher by the end of the week, and I'm going to give it the confidence. I kind of want to couch a little bit, but I think I'm going to go ahead and give it a confidence of a 7. So I'm going to say that we're going to finish the week up, and I think I feel about a 7 as far as confidence is concerned on that. Okay, David, if you hear any word from Glenn or whatever, just interrupt and let us know, and then we'll go back and get those questions answered. In the meantime, James. Question number 1, what developing events, and they can be technical or fundamental, will you be watching out for next week, or I should say this week, the week ending December 12th, that might have a positive or negative impact on the S&P 500 and other U.S. markets? And I think you alluded to a little bit of that already, but let's go ahead and hear what else you have to say about that.
Right. So, like I said, it's a pretty thin calendar for macro data this week, and this is a kind of strange time of year to be trading the market because, you know, we had Draghi come out last week and say, hey, we're not really going to make any major moves as far as policy goes until next year. So this one big point of uncertainty got kicked down the road a little bit, and that what should have been a big catalyst for the market got put off. We're through all the earnings, or most of the earnings. We're getting into the tail end of the cycle here. But what's interesting is that as we get into the tail end of the earnings cycle is when we start to see this kind of the trade in oil start to develop a little bit, because at the end of the earnings cycle, that's when a lot of the retail names report. And like I said, those are the ones that are really going to be benefiting from, you know, a continued down move in oil. This week specifically, I think we're going to be keeping an eye on crude oil futures and what retail stocks are reporting this week, individual names, to see what they're going to say in terms of guidance for next year, because, you know, this has been a pretty quick fall in oil, so whatever discount or, you know, rebate the consumer has gotten because of that probably isn't going to come through in this quarter's earnings. But they should, you know, if this dynamic really does play out the way that everyone thinks it's going to, it should show up in guidance for next quarter out of all these names. And I think if we hear good, positive things from these CEOs of these retail names, that should help the market move higher. But, you know, there's a pretty decent chance as well that, you know, we kind of have a choppy type of grinding week because there's no macro data events, and we're getting, you know, we're starting to get into the holiday season as well. Volume tends to thin out a little bit, and, you know, institutional order flow kind of disappears for a little while until we come back into the new year.
Absolutely. I can't, you know, that's the problem we've had with the shows lately is that we have no controversy, and I can't really, there's nothing you said I could disagree with. I like that, you know, you pointed out the lag in the crude oil effect, and I find that kind of interesting. I'm a technical guy, 100% technician. I don't even put the TV on in my office during the day, so I'm just keeping an eye on the charts. Again, like I said, I don't like the drifting action in the S&Ps, in the S&P 500, but it is what it is. Like I said a second ago, I'm glad to see a tiny bit of volatility creep into the market today, so maybe that'll get this market moving again. I'm not going to fight it. The trend is up. I've actually passed on a few shorts lately, and one or two of them worked, but I'm okay with that because so far the trend is up. Again, it's decelerating. I prefer some acceleration. When a trend begins to decelerate, you have it's like the buying has begun to exhaust itself, and you wonder who's left to buy. And it seems like it's just sometimes you get those Johnny-come-latelys or the fast money. But again, I don't want to think about it too much. I like to see the S&Ps hold above 2050 or so, and I think as long as we do that, I think we'll be fine. And then one last point, as a trend follower, again, we were just at new highs coming into today. We're only a few points off of new highs, pretty much whatever we're down at the moment in the P is about 9 points, I guess. So we're within about 0.5% of new highs, and I'm not going to argue with new highs. So far, so good, as long as I can just keep chugging along. The only other thing, I was glad to see the Russell 2000 come back a little bit. I'd like to see that stock make new highs. It was hit fairly hard recently, so I'd like to see it come back and make some new highs. But so far, so good in the overall market. Okay, David, no word from Glenn yet, right?
No, not yet. I guess he's still having some problems with the computer.
Okay, sorry to hear that. Okay, James, question this week is, how do you overcome the emotional aspects of trading?
Right. I mean, so that's huge. I mean, probably almost just as important as your actual trading strategy is dealing with that. I mean, I still get upset sometimes. I've been known to, you know, punch my keyboard or throw my mouse. Everyone does. But I think that it's really, really important to have a plan and stick to that plan. And one of the things that I do in kind of the 3 different trading plans that I run, I have one that focuses on following institutional order flow, watching the tape for block trades and equity options. I also have an earnings trading plan where I trade catalyst events using option spreads ahead of earnings. And then I also have a day trading plan for trading individual equities using technical indicators like the Ichimoku Cloud. But one common thing, there's a lot of all those three different plans have different ways that I go about analyzing setups and entering trades, but there's one common thread through all three of them, and that's as soon as I enter a trade, I have predefined entries and exits and stop losses, and whether or not it takes a day or a week to get to those profit targets, I'm not moving them around, right? So once I have those in place and I have those hard profit targets and hard stop levels put in, I know that emotion is taken out of the equation right away. I'm in the trade. It's either going to be a winner or it's going to be a loser, and I'm not going to be moving my stop. I'm not going to be moving my profit target, because I think it's kind of irresponsible from a risk management standpoint to trade any other way than that, because if I see a setup that I think is attractive, a trade that I think has a good reward to risk ratio, and then I go a week from now and change that by moving my stop or taking a profit target somewhere else, well, then I've completely changed the reason why I got into the trade in the first place. And what I liked about it is not really what's driving the trade anymore. It's something else that has come in and made me change my mind. Maybe a fear of losing money, or greed in trying to get more out of a setup that I initially thought could only go to level A or level B. So I think really doing that, regardless of what your trading plan is, if you're an options trader, equities trader, you're swing trading currencies or day trading futures, I mean, putting in those offers, putting in those stop losses as soon as you initiate a trade and not moving them is really the best way to take emotion out of trading. Otherwise, I mean, if I have mental stops or I'm hovering my finger above the mouse to click a bid to get out of a position, it's really easy for me to go, give it another nickel or give it another 10 cents. I think it's going to come back, but that's a really bad way to trade, and that's what you'll feel some pretty strong emotions when you start losing money because you're doing that.
James, once again, we continue with no controversy. I think everything you said was beautiful. I love one thing that you said that I'm going to touch upon in 1 second is plan your trade and trade your plan. And one thing you alluded to is what I call micromanaging. And that's probably one of the biggest problems that I see with many of my clients is that they're micromanaging and second-guessing and trying to outguess the trade. So plan your trade and trade your plan. Excuse me. I was speaking in San Francisco a couple years ago, and Denise Scholl was speaking, and I guess she's a behavioral psychologist, and she was up before me, and I was listening to her speech, and it was kind of fascinating. One aspect really fascinated me is that she said that if you don't have the ability to have emotions, you cannot make decisions. And he said the people that have had the unfortunate luck of having a bad accident or something, and if they damage the part of their brain that controls their emotions, they no longer can make decisions. So we're told to control our emotions, but without emotions, you can't make decisions. So you have to embrace your emotions. And the example she used was that when speaking with someone who was having a doctor visit, if you asked them if they want a doctor visit on Tuesday or Wednesday, they would go through every reason they should do it on Tuesday and then every reason they should do it on Wednesday, and then they would start over again because there's no emotion attached to that. So every decision in our life is made, it's been proven scientifically, it has some emotion to it. So obviously, just because we decide to become traders, it's not that we no longer have a pulse. And just like you said, I'm so glad you talked about how you still get emotional. I certainly get emotional quite a bit as a trader, drop a few F-bombs now and then. But the way I overcome that is most of the things you already said. First of all, plan that trade and trade the plan. I'm amazed at how many people will not plan their trade. And I thought about it long and hard, and the answer is, I think at least, is because the moment you plan that trade, the moment you say, okay, this is the level I'm going to stop out if I'm wrong, is the exact moment that you admit that you could be wrong in a trade. And I think psychologically we don't like being wrong. So as long as you're kind of winging it without a plan in place, I don't think you're being true to yourself and admitting that you can be wrong. So very important to plan the trade. Very important to trade the plan. And for some reason, that's incredibly difficult for most. But if you actually have a plan in place, and just like you said, James, know where you're going to get in, know where you're going to get out, know how you're going to trail those stops or whatever your methodology calls for, and just letting it play out, whatever time frame that may be. And don't micromanage it because 10 minutes later the position moves against you and you're thinking, oh, well, maybe my analysis was wrong. And one thing that I often say, and I'm going a little longer just because we got, and you could chime back in too, James, because we have a little time today because we have fewer guests. But one thing that I often say is obsess before you get into a trade, not afterwards. And one thing that I have found is trading done properly, not all the time, but quite often, if you're doing it properly, it can be quite boring. And then the only other thing I would say to help overcome the psychological and emotional aspects of trading is sometimes maybe play a little game with yourself, with like try to detach yourself, like you're observing things as opposed to them happening to you. And I think what Mike Tyson once said, everybody's got a plan until they get punched in the face, right? Well, sometimes you do get punched in the face in the market, and you just have to kind of detach yourself from that, believe in your methodology, provided you know the methodology thoroughly, and know that longer term you're going to do just fine by following the methodology and following your plan. James, you want to add anything to that, or chime in?
Yeah, I really like what you said there about, if you're doing things right, then you should kind of feel bored most days. I mean, like I said, my main trading strategy revolves around watching equity options order flow. And, if there isn't any order flow in a day of note, then I just don't have any trade setups. And I can spend an entire day sitting here staring at the screen waiting for an order to pop up that just isn't going to. And when that happens, I mean, it can start to get really easy to say, oh, well, I have a minimum threshold in terms of multiple over usual volume that is going to trigger an entry for me. Let's say it's 3 times the average daily option volume in one block. Well, look at this one. It's about 2.5. That's pretty close, right? Nothing else has come across today. I should probably take this trade. It's easy to kind of, bend the rules of your plan when things are slow or when you're not really making a lot of trades. But I think forcing trades like that is really, really irresponsible in terms of, following that trading plan. It can be really easy, especially as an options trader, when things are boring, to start to look for reasons to trade. I mean, I can start to look at all of my Greeks and say, well, maybe this trade is starting to slow down a little bit. I should flatten out my deltas and, maybe sell something against these long calls to, capture some theta decay. I mean, there's a lot more moving parts, so it can be easier to try and play with one of those parts when really I shouldn't be doing that at all. I need to stick with the trade. If I have a directional trade that I put on initially to get long something and play it directionally, well, then I don't need to come in and start to or start to play the implied vol in it when that wasn't my original encouragement to get into the trade. But like you said, it can be boring, and we say it all the time. Trading really is, hours and hours of boredom, kind of bookended by 30 seconds of sheer panic. I mean,
yeah, it's just kind of like sailing.
Right.
Back when I was a big sailboat racer, yeah, that's exactly how it was. And an interesting point that you brought up is that there's a lot of moving parts when it comes to the options world. And I could see where you could be very tempted to maybe sell premium when the premium isn't quite there, or make some kind of trade when it's not quite there, just because you're bored in the trading. With my methodology, it's a little bit more cut and dry. If the market is making new highs, there simply aren't any pullbacks. If the market is chopping sideways for months, there simply aren't any momentum stocks, and you have to resist the temptation. One thing I want to add to that you kind of made me think about it when it comes to the boring aspect of it is a lot of times, and I actually wrote an article about this recently in Traders Magazine, a lot of times and I see this a lot with clients, and that's the beauty of being on the retail side, like both of us are having a retail aspect of the business, is a lot of times we see a lot of people make a lot of mistakes, and it's a constant reminder for us not to do that. And a lot of times people do the wrong thing, and they know they're doing the wrong thing, and they do it anyway, and that's pretty amazing. And I'm not sure exactly why people do that, but usually, like, somebody will call me up and it's like, Dave, I'm having some trouble. And I'm like, well, how am I going to fix this guy or girl? And I think, well, let me just ask them what they're doing wrong. And it seems like 9 out of 10 times they tell me. When one situation really sticks out is that, and my apology to those of you who are here who already know, because I tell the story quite often. But I had one client, and he was following along my trading service over a period of several months, and we didn't set the world on fire, but we were slightly profitable over a few months. Not that I'm proud of that, but I'm glad at least we weren't negative. And he couldn't make any money, so he sends me all his trades, and we go through them. I go through them one by one, and then I said, hey, you know what? You would have been profitable, not by a lot, if you just followed the methodology, which you did right here on these trades, but you also had these 25-day trades that you made in between, and you lost $5,000 or $10,000 of those. And if you take those out, you would have been profitable, not by much, by a few $100s, but at least you would have been profitable overall. So obviously, he was firing off day trades because he was bored in the process. Again, it all comes back to plan your trade and trade your plan, and it can be quite boring. I was part of a high-end newsletter at one point in time, and the leader was Peter Mothy on that, and this was through Malden Research several years ago. And when he asked me to be on it, I told him, Peter, you don't understand. I might go weeks or sometimes even a month or maybe even longer without making a trade. Are you sure you want me on here? I'm only going to trade when there's an opportunity that presents itself. And he says, you're exactly the guy we want. And he said something I'll never forget. He said, don't invent trades. And that's always stuck with me. So I make sure I really like that setup going into it. If I don't really like it, I got to be careful not to invent trades. And James, you were saying that with the, if you got 2.5 times the volume and you require 3 or whatever the case may be, you might be more inclined to invent that trade. So plan your trade and trade your plan. Okay, David, any questions from anyone coming in while doing the show?
No questions right now so far.
Okay. And I don't know if we mentioned or not. It's TimingResearch.com /report.
Reports. Yeah.
Reports. Okay. To get this current report. Okay, James. Any closing thoughts about anything? And give us a few more words about your website, Keen on the Markets, and then we'll go ahead and wrap things. Keen on the Market, and then we'll wrap things up.
Right. So I think that was a really good discussion. I always really like the opportunity to talk about kind of the psychological aspects of trading, because I think a lot of people tend to neglect those when they're extremely important to success in trading. And we probably spend the most of our day speaking technically and fundamentally and looking at order flow, but that's always something that we touch on as well in our trading room. If anyone listening is interested in learning more about what it is that we do, and namely following unusual options activity and equity options order flow, I would strongly suggest you send me an email at james@keenonthemarket.com. I'd be more than happy to let you guys check out our trading room or any of our other services. We've had some really great people in the room, and in addition to myself and our other moderators, the community of 500 other traders in there talking every single day about what it is that they're trading makes it a really interesting place. I learn something in there every day myself from other people who are trading things that I either don't trade or have never even thought about trading before. But I can tell you, I hear from profitable traders every day who are trading, sugar markets or coffee, things that I don't really know too much about. So it's a really great place for anyone of any skill level to learn, especially if you're interested about options. And we've had some really great trades so far this year. Unusual options activity is still the best way to catch those home run winners ahead of big merger and acquisition plays. Somebody always knows, and they can't help themselves but buy some options ahead of it. And if you're able to tell what that looks like, you can kind of take advantage of that type of that information that the average guy doesn't have. So if any of you are interested in that, please send me an email, james@keenonthemarket.com. It's KEENE onthemarket.com. And I thank you guys for having me here today. I had a really good time.
Yeah, thank you, James. I like what you said about you could always learn from others, and that's one reason I love doing these weekly shows. And David's been kind enough to ask me back several times here to host, is because every time I do these shows, I learn something from someone else, and there's so much to learn in this business, and there's so many different facets of it. It's you can always learn, and I imagine with a room that big, there's a lot to learn. Anybody, if you want the special report that I have on my methodology, it's pretty much the entire methodology in a nutshell. The rest is just details, and a lot of those details I talk about. I do a free weekly webcast, and you can click on the countdown on my website for that. And I also have countdown for other webinars, such as the one I'm doing now is on there too. I answer all my own emails personally, so if there's any questions you may have, Dave@DaveLandry.com. If I cannot get to you right away, or if it's a more involved answer, what I will do is I'll actually bring that over to the show to be fodder for the show, and we'll talk about it in the weekly webinars, which are run about an hour and a half. I think that's it for this week. David, let's go ahead. I'll turn it over to you, and you could shut us down. And I want to thank everybody again. Thanks again, James, for being here. James Ramelli, KeenOnTheMarket.com, and I'm Dave Landry at Dave@DaveLandry.com, or you can find me at www.davelandry.com. David, over to you.
Okay, thanks, guys. Great show. Want to mention that for everyone watching, please be sure to go to TimingResearch.com/current survey before Sunday to fill out this week's survey. And if you have a suggestion for the unique question for the week, just go to TimingResearch.com/question and submit your idea there. And you can download the current and all previous reports at TimingResearch.com/reports. And I just want to thank my guests again, James Ramelli of KeenOnTheMarket.com. Thanks for being here again. And I want to mention Glenn Thompson of PacificTradingAcademy.com and Benjamin Lee of ThinkTradeThink. We're supposed to be here, but they ended up not being able to be on, so we're going to try to get them on again on a future show. And again, thanks for Dave Landry at DaveLandry.com for co-hosting or guest hosting again. So,
thank you again, David, and thank you. And thanks to Timing Research for having me back in again as host. Thank you so much.
All right. Thanks, guys. That's the end of the show. Bye.